All right. Oh. Hey, what's up, guys? Welcome to day, 23 of IntelligenceMaxxing. And I titled this Interview Prep Part 2. So, I recently had an interview for an internship position, I think 3 weeks ago. And thank God, I got to the second round. And so I think this round is going to be the last one. It's with, I think, maybe the Chief Investment Officer of the Maryland State Retirement and Pension System. So today I probably want to prepare a little bit for that interview. It's coming up in, I think, 2 days on Tuesday. So I just want to make sure that I can prepare some questions to ask him and talk a little bit about some of my past experiences and maybe some things about the economy and what I think about pensions. Okay, so let's start with just tell me about yourself. So I'm Brian. I'm currently a junior at the University of Maryland studying finance and computer science. In terms of work experience, last summer I was an intern at JP Morgan Chase on a software engineering team within the consumer bank, within Chase Bank. And over the course of that summer, I ended up working on a project, a full stack website that would help monitor thousands of configurations for applications within Chase Bank. And the summer before that, I was an intern at Willis Towers Watson on a pension team. I was a data intern on. I was an intern at Willis Towers Watson, specifically within their pension administration department. And over the course of that summer, I wrote a bunch of SQL queries. Pretty much over the course of that summer, I helped out the analysts by writing SQL queries to gather data for their analysis and also help build a data audit report on retroact and help build a data audit on and help build a client requested data audit. And at school, I've taken a few courses in finance at University of Maryland. I've taken a few courses in finance, computer science, and a little bit of math. I've taken some courses in finance, computer science, and a little bit of math. My free time, I really like dancing, I like skateboarding, and really into fashion. Yeah, so why do you want to work here at the Maryland State Retirement Pension System? So I told Kyondo this. I told Kyondo this in the last interview. I was born in Maryland. I lived in Maryland all my life, and I currently go to school in the University of Maryland. I would love to stay in Maryland after I graduate, but I think even more importantly, the work you guys do managing the pension plan and making these shrewd investment decisions really helps the lives of police officers, judges, firefighters, teachers, all of these people that have helped educate and protect me while I was have helped. Oh, let's see. Oh, thank you, Andre. Okay, so yeah, it's something about all these people that have helped protect and educate me. I would love to. I think I would be excited to come into the office every single day, and be able to work on things that would help these lives, these people have a really can live a life of dignity after retirement. I guess that's a good way to put it. So I'll come back to that. All right, and then University of Maryland, currently go to school at the University of Maryland. Being able to work with you guys at the Maryland State Retirement and Pension System allows me to stay in Maryland. But even better, the work you guys do helps teachers. The work you guys do helps teachers, law enforcement, judges, state employees, all of these people that have helped educate and protect my life for the past 21 years. So I guess I really resonate with your mission to provide these people with profit benefits that allows them to live a respectable life after retiring. Yeah, that's fair. And why this investment role? Okay, so I think what I talked about here was I really have two goals this summer. One of them is to learn as much as I can about investing. The second is to convert an internship to a full-time opportunity. I think maybe the third, I could add a third one here, is to just really meet some really interesting people and get to talk with them about, I guess, how should I say this? Meet interesting people and meet really smart and interesting people and be able to talk about financial markets with them. Okay, yeah, I guess I think that's interesting. So maybe those three, and then okay, yeah, I could say that. I think that an internship with your organization can help me reach these goals. You guys have 60 billion in assets and invest in 5 broad categories of assets with thousands, if not millions, of managers and individual securities to choose from. I mean, you guys are all very well experienced and are pretty much experts in your fields. So, as someone who's just starting out in their career, I can learn a lot from you guys. So yeah, to my understanding, your fund invests in 5 broad different asset categories. You have public equities, and then you have equities, rate sensitive, credits, absolute return, and real assets. I mean, those are very broad categories. And there are thousands, if not millions, of managers and individual securities to choose from. So there's definitely a whole universe for me to kind of dive into. Oh, yeah. So, market views. Why investing? I think the biggest reason why I want to go into investing is because of the impact it has had on my life, but also the impact it will have on billions in the future. Okay, yeah, so I think this part, maybe I should say something along the lines of looking back in my life and how investing has impacted me. I could talk about the opportunities that it unlocked, specifically maybe the Maryland 529 plan. So, how should I say this? Why do you like investing? So for me, maybe investing allowed me to making shrewd investments. Investing allowed me to completely pay for college using funds that my parents saved over time and was able to put that into a Maryland 529 plan, and now I can go to school debt free, even though my parents they have a pretty good job, but not crazy pay, and so maybe that's how I can kind of tie investing into why I want to go into this field. Okay, tell me about a okay, what do you know about pensions? Right. Okay, I think oops. I'm gonna go over one more question and then I'm gonna take a look at the most recent annual report just so I can get some understanding of what's going on here. And then also they have these meetings that they have every quarter, and it would be nice to see what they've been talking about. Fiscal year quarterly performance reports. (2023) Q3. I guess it's Makeda. So, I didn't know this, but pension plans, they hire a lot of consultants, it seemed like. These consultants help prepare first, the actual actuarial rate of return. I think they help with the benchmarks and evaluation of investment managers. And okay. Maybe it'll be good to understand some of the benchmarks that are being used here as well, since it seems like they have target range, public equity, sub-asset classes. Yes, yes. Growth equity, rate sensitive. Okay. Maryland State Retirement Pension System meetings. Board of Trustee meeting minutes. I think that's what this is. Board of Trustees. February 14th. Investment Committee. Public advisors. This position, universities, public advisor to. Okay, committee meeting minutes. Let's see if this is interesting. Is there anything here? Investment committee minutes. September. Okay, motion by Comptroller Lehman, ratified. Discuss the various responsibilities and duties of the investment committees. Review the strategic plan of the investment division. He discussed various elements and implementation efforts by staff relative to the strategic plan, highlighting a forecasted target versus actual results since the plan was launched. This is about legal costs for outside counsel. Reduce management fee expenses, investing in private market co-investments, and internal management of a portion of plan assets. Mr. Sandless asks how to propose salary for the new associate positions, compare with similar positions in the market. Discuss current investment initiatives, including processing and recruiting, the position in private equity, review the current risk budget of the plan in the context of the asset allocation decision framework. Okay, so it seems like the big way that investments or that these pension funds track the performance is with benchmarks. And so I think one critical question I'm missing here is maybe how would you evaluate a investment manager? So I think this is probably going to be a pretty substantial question that can ask, kind of like a case study here. So how would you view an investment manager? All right. So I think there's a few things we could think about here. First, it's what asset class are they? Do they have some type of edge against their competitors? So and then how do you evaluate edge might be difference in different asset classes. Could be new technology or exclusive network or deal referrals. Okay. Is their strategy differentiated? Understandable. So this is kind of related to the edge point. Okay, so how does the fee structure work, and how does the fee align with incentives? Okay, so I think this is something that we actually talked about a little bit in class. Kind of how fee structures and how to align them with incentives. I think making some. So what we learned about in class really, we really talked about David Swenson and how he thinks about hiring investment managers. Our professor kept telling us, not kept telling us, but he was painting the idea that he kind of thought in order to align incentives with some of the investment managers he hired for the Yale Endowment, that he would give them some type of performance incentive and with the fee structure. So how that worked was usually you have this idea of 2 and 20%, so it's 2% of assets under management and then 20% of profits. And I think David Swenson, he would really emphasize on that 20% of profit, and he would use that to kind of align the incentives of some of the investment managers he hired, because in order for a company to actually, I guess, an investment manager to earn money, they would really, David Swenson would really focus on the profits that they generated, and he'll give them the 20% of those profits. And I think that meant that the underlying 2% of assets under management, he would prefer that to be less, maybe a 1% or even less than 1%. So it's just enough to cover the fixed costs of the asset manager, but not enough for the asset manager to be able to earn a consistent profit off that fixed amount. Now there is the case where that fixed percentage does increase as your asset size or your asset base or your asset under management increases. And so that could be a reason why, that could be another incentive for investment managers just to be able to increase their assets under management. I guess these are a few things that we should think about here. All right, and then do I fully understand the risk involved here? How does the fee align with incentives? Okay. And then maybe something about, yeah, are they trustworthy? So this can be kind of subjective. Okay, so how do you evaluate an investment manager? Yeah, that's kind of a broad question, and the way that maybe we can narrow this down is kind of figure out, or maybe ask some follow-up questions. So the first one maybe could be, what type of asset class do they specialize in? Are they focusing private equity? Are they a hedge fund? Are they more focused towards public equities? Maybe even domestic versus emerging market versus developed or international equities? Or maybe there's some type of fixed income firm that really focus on debt and credit. So these are some kind of questions I would ask myself, and then the next step would be understanding what their competitive advantages, or I guess you could call it their edge. So why or how are these guys better than other possible investment managers within their specialty, maybe within the asset class? And so this is something that I feel like it's difficult to measure, especially I feel like this is it difficult to measure? I don't know. So, okay, before I even get to that, what am I thinking about when I think of an edge? Well, I think maybe that it can come in different forms. Maybe the firm has some type of proprietary technology, maybe a really fancy machine learning model that can really predict expected returns. That maybe these firms have fancy machine learning models that can accurately predict expected returns in the long run and the short run. Also, maybe if it's a private equity firm, whether or not, or a private equity or a venture capital firm, the types of deals that they have and the network, I guess the number of deals and the types of deals that they have, and the network, or you could call it prestige within the industry. I feel like that in itself is some type of edge over some smaller or less well-known venture capital or private equity firms. So these are examples of edges that are competitive advantages that I might be looking for. And then maybe quantitatively, I could look at the performance of these firms relative to some type of benchmark that I think is accurately depicting a similar risk that I think might accurately predict or accurately some type of index that is suitable for comparison. Maybe that's the way of saying it. Okay, third, maybe I should say, do I understand their strategy, their investment strategy, and do I understand the risks that are associated with this investment strategy? I think this maybe is, I think this one is especially important to understand how the investment manager is thinking and what type of opportunities they're looking for. And to me, as a fiduciary towards the thousands of plan participants, it's pretty important that I understand what I'm getting myself into, or what I'm getting the entire fund into, especially when it comes to risk management. I think maybe with hedge funds, maybe even private equity firms, some of them might not be completely transparent with some of the strategies that they work on. And I think as a fiduciary, it's important to understand what the risks are associated with their strategy, whether they're leveraging maybe 2-to-1, 3-to-1, or engaging in some risky trades, Maybe they're overexposed to a certain type of security or trade that could blow up. So these are all different things I'll consider. And I think the last, maybe another important one, is how the fee structure works. Okay, so I'm just kind of spitballing here, and then maybe I'll have something more concrete. Oh no. Okay. Damn. Move down. Slid and Yast. Let's go. Okay. What asset classes are they? Do they have some type of edge against? Okay, so let's start from the top then. How would you evaluate an investment manager? Okay, I think this process, I think maybe starting out in this process, I might ask myself a few different questions that kind of help me guide me in my decision and in my decision making. So the first one I think could be, okay, so I'll try to think out loud here, and maybe think through how I would think about this process. So I think I'll try to think out loud and kind of maybe walk and just, okay, so I guess I'll just try to think out loud and walk through the process of some of the questions I might ask and some things that I might be looking for. So when I'm thinking about this problem, there are some questions that I do have, and the first one is, okay, what type of asset class is this investment manager specializing in? What type of investment manager are they, right? So are they maybe a manager focusing on public equities, fixed income? Are they a hedge fund, private equity firm, venture capital firm? These are all different types of investment managers that you guys hire, and so I think that's probably the first question I would kind of ask and start my discovery. The second I would say is, okay, once I figured out what asset class these managers specialize in, are they do they have some type of competitive advantage in this space? I guess you could call it an edge, an edge. I guess you can call it some type of edge within whatever asset class or whatever they specialize in. And so when I'm thinking about this competitive advantage, it can take many different forms. Maybe they have some really cool proprietary technology like a machine learning model that can predict the expected returns of some index or some stocks with pretty good accuracy. Maybe it's some specialized data, proprietary data sources that they have. Or maybe even when I'm thinking of, let's say, venture capital or private equity firms, some of the brand name behind the firm, I think, it does matter. It enables them to get access to deals that maybe smaller or less well-known venture capital PE firms get access to. And I think that can really be a differentiator within the private equity venture capital space. And then from there, I would say, okay, so maybe they do have a competitive advantage, maybe they don't. Do I understand the underlying strategy, at least, of what this investment manager is trying to implement or has implemented? I think as a fiduciary towards the thousands of people within this fund, the plan participants, it's important for me to understand what are the risks involved with hiring this investment manager, and that comes down to understanding what their strategy is. And so, let's say you're a hedge fund, you probably are not that transparent with what you do. I think that maybe is a yellow flag. Maybe that could be a yellow flag for me because I don't know what I'm getting myself into. I don't know what I'm getting these plan participants into. But then there's a trade-off of, hey, maybe they are really great at what they do and they don't want to expose it to the world, but it is still an underlying safe investment. So I guess there's trade-offs with that too. And then I'd say probably the last big thing I would think about is how does their fee structure work, and is the fee structure set up so that it really aligns with the incentives of, it aligns with the incentives, and is the fee structure set up so that both of our incentives are aligned? And so when I'm thinking about this, I'm thinking of kind of from the standpoint of, okay, an investment manager can collect fees from us, let's say a fixed rate fee, 2% of assets under management, and they can just keep collecting that 2% no matter how well they're performing. So I think that probably isn't aligning the incentives correctly. Okay, how does the fee structure work and how does the fee align with incentives? So this is actually something that I've been talking about in one of my finance classes, and I think there have been a few different ways that investment managers have approached this. And so for me, just in my completely naive experience, I think an interesting way to think about this problem is how the I think an interesting way of approaching this problem is how do we reward managers for doing really well, and how do we keep them how do we get them excited to do well? And I think that comes with an incentive performance or some type of performance incentive or performance bonus. And I think that's something that could possibly align the incentives of a lot of investment managers to not just to really limit the fixed amount that they can charge, maybe just enough to cover fixed costs, but being able to set up a fee structure so that so that good performance is rewarded well, and continued good performance is rewarded really well too. Now, I'm sure there's trade-offs, and there's definitely trade-offs with this idea, and I think maybe that trade-off exists between different asset classes, but I think following through this framework of asking these questions, I think is probably how I would approach this problem. Oh, okay. Keto. So, okay, what do you think about the markets? I think this is another thing. Okay, so let's say, oh, this one right here. So let's update our market views, right? So we had said before that in the case of a stronger recession, we really have high credit card debt, low savings rate compared to long-term average. Student loans are being repaid again. I think we could also add here, these are all things that I don't think have really subdued. And another big thing is the Chinese credit crisis. So I believe in China, a lot of real estate developers are going under, and it's really causing some type of credit crisis within China and devaluation of real estate, which is a big investment within Chinese consumers and the Chinese economy in general. So I feel like that can definitely impact the returns of emerging markets and maybe have some type of spillover effect within the US economy. So that's another big thing. So I think another thing is earnings for still strong in the most recent quarter, and then for real GDP growth is still is also strong at around 3%. Okay. Corporate earnings. Year-over-year earnings growth rate is 2.9% for SP 500 firms. Consumer 25-year average. Care sector. So you could argue that consumer discretionary subsectors, so automobiles, leisure products, facing negative year-over-year. Care, consumer discretionary. Consumer growth, consumer discretionary. Consumer discretionary revenues are low. So this is according to FactSets. Around 50% negative surprise. Fox Corporation. Citigroup facing negative. Expedia group. Edison. Edison International. Expedia. Jeez, okay. Forward PE ratios to be strong. Excuse me. Buy more than hold, more than sell. Consumer discretionary. I think it's around 20. Or PE. So what is, I feel like forward PE is just a way of saying that price you would pay for expected returns in the future, or expected earnings in the future. If the forward P ratio is higher. Yeah, that makes sense. And 18. So it's the current price divided by futures earning per share. And so if the futures P ratio is higher, that means that future earnings per share is declined. And so that's not a good thing. So I think that's what fact set. Okay, so I guess there's also, you could say that there's also a consumer, not consumer, but commercial property bust is contained within specific regional lenders. Okay. And so I think maybe the idea, there's could be a looming problem with commercial defaults, especially on commercial offices, commercial property, but I think some of the people on the other side argue that who's the guy? It's the head of Norbert Bergman and Big Short guy. Okay. Bergman. Here we have Omar. Steve Eisman. Steve Eisman. Okay, so I think that's pretty solid of maybe this is kind of since the 2 weeks earlier. This is kind of some of the developments that's been going on in the markets. Kind of start from the broad overview here. There's really, I think, two camps of people, and there's people that are, I guess you could say, bullish, and people that are bearish. So that's fair. There's always two different camps, and I'd say I'm leaning a little bit towards the bear view, but I am not 100% committed. I think that both of these chances are pretty. I think both views both have each of their both have really good. I guess both of these views have good reasons or data to back their views. And so I guess maybe on the bear side, so looking at the current state of, I guess you could say, the US consumer and the US economy, there's a few things that might cause some worry. So the first one really is the amount of debt that the US government is taking on and the amount of debt that the US consumer is taking on. It isn't as bad, I don't think. So I think there's a record level of credit card debt, and also there's a low savings rate compared to the long-term average, and including, and coupled with that is the oh jeez, okay. Coupled with that are student loan payments that affects 45 million Americans. And then that affects 45 million Americans. And then from a kind of a public markets point of view, I think we have seen, so I think in maybe the latest earnings, and so I think in latest earnings, some of the sub-industries within consumer discretionary have seen declining earnings per share growth and also declining revenues. And I think somewhere in a FactSet report, they were estimating that the S&P right now, the forward P ratio is a bit higher than the long-term average, suggesting that maybe investors are thinking about a decline in the future, in the next 12 months. And then you also have this idea of commercial property busts that could happen within whoever knows how long, maybe in the next year or two when these leases start to expire. And then when you look around the globe, there is this idea of, and I guess when you approach this from a global point of view, okay, so how should I split this up? So maybe split this up into, so I'll split this up into 3 different parts. So there's the credit status of the US, and then there's also the public markets and the global, I guess, economy. And so in terms of credit within the US, there's a few things that bears might look at and see that this might cause some worry. I think first one is just the overall outstanding debt that the US government owes, which is, I think, at a record high, more than $100 trillion, and I think maybe over 100%, over 100% of our annual GDP. All right, so actually no, I don't think it's 100 trillion, maybe 30 or so trillion U.S. debts GDP. Alright, so how much U.S. federal debts? 34 trillion, okay. Student loans. And then when you look at the public markets, I think what we've seen in the most recent earnings season is some industries performing really well. I think what we've seen, I think in the most recent report by FactSet, I remember reading a recent report on FactSet, and they were saying that some specific subsectors in the consumer discretionary industry are facing negative earnings per share growth and also negative revenue growth, specifically within automobiles and leisure products. And as a whole, revenue growth in the consumer discretionary space is declining, or I think has faced some declines within some companies. And then you also have the forward P ratio of S&P 500, a bit higher than the long-term average. Now, looking at the global view, I think there's a few things that are kind of, so I think there's a few things that we could take a look at here. First, geopolitical risk, so definitely wars in Ukraine and Russia, and Israel and Gaza, and also in the Red Sea. But there's also a credit crisis in China right now. It seems like a lot of real estate developers are going under, and there's a declining real estate market and devaluation of real estate within China, within China. So switching over to the other side, I think what we could switching over to the other side, I think what bulls have really been thinking. So go into the three different. I'll talk about the three different areas again, and so in terms of credit in the U.S., I guess bulls could argue that we do have the reserve currency of the world, and so maybe you could say, let's say, rising wages to service debts. I have to take a look at that. So rising wages. Inflation, so, okay, yeah, this is something I could look at later. But inflation falls to 2% and Federal Reserve, okay, so I think some bulls have been thinking about current inflation is pretty stable now, really close to 2%, and the Federal Reserve might cut rates maybe 25, 50 basis points within the next year, which can really uplift the valuation of assets and stimulate the economy. But that's still a really big uncertainty. And I think another big thing that's another catalyst is earnings in the most recent quarter have been pretty strong for most companies within the S&P 500. And also real GDP growth was also really strong, about 3%. And then so that's in the public market space globally. And then you can also say commercial property is also contained within regional lenders. From a global point of view, a lot of these things are taking places in different economies, and you could argue that there is a trend toward deglobalization, less reliance on manufacturing in China or India, Vietnam, maybe less reliance on manufacturing in China, and onshoring or reshoring most manufacturing capabilities, or maybe at least in the North America, Central America region. So maybe these economic disasters or economic crises are kind of self-contained within their own economies. So that was kind of a brief high-level overview. When I think about this economic stuff, I don't fully have a clear mental model of how to connect the dots and what the cause and effect relationships are. So I think that's something I do need to build on as a skill as I hopefully become a good investor. But I think what I'm going to do now is I'm going to go shower and then go for a walk. So I'll see you guys for now. This is a good review. Probably come back a little bit later and pick it up. So